I'm not interested in looking rich. I'm interested in being free. Okay, this video is not going to be about Lambos. It's not about hype. It's not about shady trading courses, okay? This is real, old school, tried and true methods that helped me build a multi-$100,000 net worth by the age of 34. I didn't do it through penny stocks. I didn't do it through crypto. I sure as hell didn't do it through chasing hype, man. Okay? What I did was I diligently learned how the rich actually invest. It's a lot more boring and easy than you would think. I took that play. I ran it over and over and over again for years, for a decade actually. And I'm telling you right now that you don't need to wait to be rich to start to implement these methods, okay? You can start with like $50 a month. That's probably what I started with back in the day. Time and discipline are the real keys to success here. Number one, you got to stop chasing that quick dollar. You got to stop watching the guys in the Lambos, okay? You need to shift your mindset. Most people aren't really trying to get rich. They're trying to escape their situation. They're broke, they're behind, they're frustrated, and they want to be anywhere else, and they want to be there now. That's why they fall for the loudest voices in the room. They fall for the people screaming 100x on crypto gains, meme coins, buy this penny stock, buy my trading course, flip this in 24 hours. I've chased that stuff, man. Every single time I've lost money. And I'm just going to let you know, like, it does not work. Maybe 0.01% of the people can trade. I'm not saying it can't be done, but 99% of you listening is not going to be you, man. What you should do is work on accepting that, okay? You should work on accepting this is where you are right now, but if you don't play these dumb games with your money, then you won't be here forever, okay? Once I really internalized that, that's when things really started changing for me, okay? The way I actually built wealth was not from genius stock picks. It's not from some secret formula. It's just boring, consistent, long-term investing, like ETFs, S&P 500 type stuff. That's the stuff that no one really tells you. You don't need to find the next Amazon. You don't need to discover some unknown company. You just need to buy great businesses at the right time. Great businesses is at a great value. That's what Warren Buffett always says. People at parties always ask me, do I need to find the next startup? Hasn't all the money already been made in the big names? No. I'll tell you real-world examples in my portfolio that have killed it for me. Amazon. I've dollar costed into Amazon over the past decade, and on my cost of capital, I'm up 221%. That means I put a little over $3,000 into it over the course of my life, and I've made over $7,000 in gains. Google, I'm up 161%, same thing, and it's been paying me dividends now for the past 2 years. One of my biggest winners, JP Morgan, up 206%, and that's been pumping out steady dividends. They pay a pretty decent dividend over the course of like 10 years. So you take that 206%, it's probably closer to like 240. You know, that's not luck. That's value investing. That's me recognizing great companies. It's recognizing when they're undervalued, and it's buying in and not being scared to take that chance when I see that opportunity. And I let time do the rest. Okay? This is a lie that the industry pushes on you, that you have to pick between value or growth. It's either old, boring dinosaur dividend payers or these shiny tech stocks. And that's just not true. Okay? My biggest winners, and I just named a few of them for you, they were both. They were value, priced at the right price, and they were growth capable. It's really just about getting something good at the right price. This is how I pick stocks. And I'm not a guru, I'm not a CFA, I'm not a financial advisor, and like, if you get nothing else from this video, it's that you should go and do your own research and become a student of the game, because there is real risk associated with investing. But here's some frameworks that I use when I'm going to analyze a stock. I'll look at metrics like price to earnings, and then I'll get the PE ratio. You'll see it on Yahoo Finance. And then I'll compare it to their historic price to earnings. I'll compare it against the industry. I'll look at the direction that their key free cash flow is going if you look at their financials. I'll look at insiders buying. I'll look at who owns it. Is it in big S&P 500 ETFs? Do they have a strong moat? Look at what is the actual business doing. Is there brand strength? Do they have market share? Are they a dominant person with market share? You see my stocks, dude. I want winners in industries, okay? I want to pick the best of the best, and I want to hold them for forever. If you're not comfortable holding it for 10 minutes, if you're not comfortable for holding it for 10 years, you shouldn't hold it for 10 minutes. That's what Warren Buffett says. No one of these metrics in isolation can give you the full picture together, but if you aggregate all of them, it should give you a better idea. And listen, man, I got friends who are financial advisors, and at the end of the day, they say the same thing. They can't guarantee you what's going to happen to it. They take a bunch of information, they bump it up against once they know, and they make some educated guesses, and they diversify. If you want to get some other outside opinions on a stock you're looking at, I like Daniel Pronk on YouTube. I think his videos are absolutely phenomenal. I like Dividend Data. But, go find your own videos. Just make sure they're reputable and make sure they're not pitching you something crazy that sounds too good to be true. Okay, you don't need to master any of this stuff. You just need to understand it enough not to get played. Sometimes you are still going to lose, and that's where diversification will save you. Okay, sometimes I look at companies. Intel was an example. I thought would be a good investment. It did not pay off. I ended up losing some money on it. And in my personal portfolio, I own over 30 companies, and I'm up on probably 80-something% of them. But if I only went and made that one bet on Intel, I would think investing doesn't work because I made a poor bet. I never let one of my positions make up more than 10% of my total portfolio. I don't panic when something goes down. I review quarterly, maybe, not daily. I don't expose myself to any one thing. If you overbet on one stock and it goes south, then you think investing is a scam. That's how people get jaded on it. Like me, even though I've had a few losers over the years, like I've seen it work on net. I see how much I'm up on all my stocks over time. And I recognize that as long as I'm picking good companies at a good price and I'm diversified enough, then I'm not going to take a total loss. I know like Charlie Munger would say that a diversification is for the know-nothing investor. Like that's fine by me, baby. I'm building this thing so it won't fall. So my strategy right now is, and this is like another thing, you should know what you own and why you own it. Like it's not about just buying random stocks, okay? Right now, I'm about 50% growth, if you want to call it, meaning lower paying dividends or no paying dividends, but the business is rapidly growing. And 50% dividend focused. These are more mature companies that are paying out a larger portion of their earnings in dividends. That doesn't mean you can't get growth companies paying out high amounts of dividends, but generally speaking, people like to divide them into those two categories. So some of my dividend stocks are growth monsters, okay? Google is, I would call, much more of a growth stock. They pay like 0.5% of a dividend. So if I own $1,000 of Google, I'm going to get paid $5 in dividends. But they raise that dividend rapidly over a year, and they reinvest the rest of the capital. They don't dividend out in the company, and that's how the company grows. The secret to building wealth is not timing the market. It's not going and finding some secret coin. It's doing the right thing. It's doing it long enough that it starts to work, and it's not getting scared when everyone starts running the opposite direction. If I were starting over again with maybe like $1,000, what would I do? Well, I would probably go and put 500 into like an S&P 500 ETF like VOO or IVV. And then I would use another 500 to pick one or two individual stocks. I think that's going to guarantee me market returns for half of that. And it's going to give me some skin in the game with some individual stocks. And I'm going to start to like learn about if my investments pan out or they don't pan out, why. And that's just part of, you do go through a little pain sometimes, and that's part of it. Anytime I've lost money, I went and learned everything I could as a result. So ideally, you don't ever want to lose money. Occasionally you will, and you try to reassess and figure out what went wrong. Will it feel slow? Yeah. But in 3 years, when you see your dividends coming and your portfolio is doubled, you'll get it. People always go like, I don't want to value invest because I want to be rich. I don't want to value invest because I want to be like rich tomorrow. But they don't realize like 5 years is going to pass. And I see so many of my friends do this, and they're still playing this game trying to day trade. And 5 years pass, and they're still freaking broke. And guess what? 5 years passed, and okay, I'm not retired, but I'm going to tell you something. If I like look at my portfolio and I'm honest with myself, I never thought I would have this much disposable capital in my life, let alone at 34. Not that it's a ton, but it's a ton more than you can do just saving a paycheck. So you don't really have to wait till you're retired to like see the benefit and like understand compound interest. You'll see it way before, and you'll be happy, and that's how you get addicted. You just need to get to that point. So I don't know, man. In closing, it's not just about money. Investing is about confidence, it's about peace, and it's about having options. I'm not even rich yet, but I'm not scared about it anymore, okay? Because I understand it's happening. That's not a flex or anything. It's just seeing the situation for what it is. So if you're just starting, here's my advice to you. Play the long game, stay consistent, ignore the noise. Ignore the noise. Ignore the noise. Ignore the noise. Guys, you will not get rich tomorrow. If something sounds too good to be true, it is too good to be true. If I could go back and beat this into my 18-year-old head, I would. All right? Don't stop when it feels boring. That's when it's actually working. You're going to have months where it feels like nothing's happening. You just got to stick the course, man. I promise you. Appreciate you guys sticking around. I really hope you take some of this to heart. And, I hope you take this. And if you have an appetite to start investing, I just really hope that you don't wait. So, the best time to start investing was yesterday. The second best time is today. If you have any specific questions, I can go over more in depth, like any topics I covered in this video. Just let me know in the comments. Would love to hear from you. I'll reply to pretty much everything I see. And, let's just all keep building this wealth. And, I hope you all are able to build the life that you want. Peace.